Andrew's asked a question, what are the pros and cons of NDIS property versus buying our push assessment properties? So I might just talk about our push assessment properties firstly. They are, our whole infrastructure, all of our technology and our experience, in terms of employees' experience and also business experience has been optimized and perfected to purchase a very particular type of property. Very strong and outstanding, best-in-class capital growth from 0 to 5 years. Our track record of 17.7% compounding over a rolling 5-year period is second to none, and it's very hard to argue with those types of returns in any investment. So we are buying an unadulterated, absolutely blue-chip, first-class capital growth asset, but we are buying them in markets where the yield is at a high point in the cycle. So they generally are accompanied by good, strong yields. And as we have just seen, they are spread out across 3 of our capitals and 4 regional precincts across the country. So 4 regional states, parts of 4 states in a regional capacity, and 3 capitals. So we don't discriminate between regional, and this is a fallacy or a myth. We don't just buy regionals or just buy capitals. We are buying a very consistent, high growth asset, but they generally do all look pretty similar. Okay, they have broad appeal, good bones, established properties in reasonable condition. And because we're buying them at the right times to enter into those markets, they generally have a good, strong yield when you look at a national basis. Minimum 4, usually 5, sometimes 6, 7, and even more than that if it's a lower budget. So you've got to look at the overall returns of a property as a sum of its parts. Ability to buy under market value, ability to potentially add value through a value-adding process, renovation process, etc. The ability to generate returns from cash flow and then also capital growth. So 4 elements combined to create that overall push returns. When you compare that to a NDIS type of property, right, you might be building it specifically for a purpose. Okay, and ordering and things do change with NDIS. You might have an agreement with it to build it to a certain specification for a certain disability or even a certain candidate working with the NDIS program. So it's going to be a very bespoke, fit-for-purpose property. And because of that bespoke or, customization, you might not be making money through the buying and the construction or completion part of that process. So we're generally seeing that the margins and the equity positions on entry to these properties is, if anything, not much, okay? So that'd probably be a con. Your acquisition and your entry into these properties is at market and very little scope there to profit. You've now got a bastardized or very bespoke type of property that is fit for only one purpose. So your buying pool is going to be limited to other investors, no owner-occupiers, and unless they specifically have that disability, etc. So your buying pool to flip that property or to move out of it is always going to be limited. It's only going to be applicable to investors or other investors whilst you have those tenants in there. And that's very limiting from a capital growth perspective. You're going to have marginalised growth returns long term, whilst your only target market for a sale would be investors. If you don't want to sell and you say, well, that's fine, I just want the yield, well, guess what? Valuers are going to know that and they're going to value that property accordingly. So your capital growth performance and your refinance abilities throughout ownership are going to be compromised. Your yields are great, but I have heard some 2 sides to every equation. You've got to dig a little bit deeper. The yields are great when there's tenants in place, but you build the property and it doesn't guarantee that the tenancy will happen or that they will come. So there are a lot of spruikers and a lot of sharks floating around the NDIS world saying build, 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 and then you've got a customised property and then the tenancy has been yanked off the table and you're left with this really funny kitchen or really funny floor plan without a tenant, right? A nightmare scenario. So, if it all works well, you're left with 15, 16% returns from a government type tenant, but don't expect there to be any capital growth or other elements of a push property. So, if you do have a sole focus on yield, potentially look at it. But very rarely would that be your sole purpose. And I do stress, guys, we have been doing a lot of work lately with ALIC, Australian Lending Investment Centre. Amazing bunch of guys. I just did a full-day workshop and picked their brains and really, workshopped some of these different strategies and options. And we are looking, based on the lending environment, to potentially, bring more focus onto a sell-down strategy to generate or create more cash flow or serviceability into a portfolio. But we're still not losing sight of the overall focus for capital growth. So it really is related to the previous example. If we are able to exit a property that is now starting to grow at average growth, right? We've done 5 years of amazing capital growth performance, and then it's starting to fall back in line with the overall city or the overall country. It might potentially be a time to exit that, refinance, regain our serviceability, and then move into another really strong high-performance capital growth property. And we are stress testing that sell-down strategy against the cash flow exit strategy because we just know the risks and the yield compression occurring in the commercial space at the moment. It's not giving us that positive cash flow that we are wanting. And the accessibility of unit blocks, etc., is very limited across the country at the moment. The number of them selling, etc., turning over is very low in the quality locations. So potentially it's bringing more emphasis back onto a sell-down strategy to create our exit. If you wanted to workshop that or wanted more information about that, we are working very closely with the guys over at ALIC to stress test this for individuals, to really map out a finance strategy along with our wealth planning process. Definitely reach out to Catherine and her team at outreach@ripehouseadvisory.com.au and they can connect you in with ALIC guys and us, and we can do that brainstorming and stress testing for you if you like. Hopefully that answers that question there. A really good one.